Are you worried about an IRS audit on your tax return? With billions of extra funding being sent to the IRS and the extra hiring, now is the best time to make sure that your tax returns for 2024 and beyond don't raise red flags. In this episode, I'm going to be going over the biggest audit triggers and how you can stay off the IRS's radar. So let's get started. Welcome to the Locum CPA Podcast. My name is Stephen Lee, a CPA based out of Chicago, Illinois. I specialize in financial and tax strategies for locum medical professionals as well as business owners. So today we'll cover who gets audited, why, and how to protect yourself from unnecessary IRS scrutiny. So number one, how likely are you to get audited? That is a very common question that I get all the time from business owners, as well as high income earning individuals. The facts, let's go over some of those. It says that less than 1% of individual tax returns are audited annually, right? Once again, less than 1%. Most audits are conducted by mail, so you'll never actually meet a live IRS agent in person, right? So most of them, it's usually an information request that you receive in the mail, asking for more additional information. That's how typically an audit is conducted and ended, usually if you send sufficient information and documentation to them. The IRS, we heard and seen all the articles that they're hiring new law enforcement agents, but most of the impact won't be felt until 2026. Once again, there's a new presidential administration that just came into office. We won't see any of the law changes for taxes really until 2026. It doesn't really affect 2025 just yet, as well as the hiring freeze that is potentially going on right now. And if you make under $400,000, the IRS claims that you shouldn't see an increased audit rate, but certain tax behaviors still could potentially make you a target, and I'll go over that as well. So the bottom line is, if your tax return is accurate and well documented and timely filed, you have little to worry about. So let's go over what are some of the top IRS audit red flags for business owners as well as individuals. Number one red flag is failing to report all your income. The first red flag is to failure to report all your income. Remember, the IRS receives copies of your W-2, your 1099, your K-1s, and your brokerage statements, right? And if you didn't report all the income and they do a matching, right? What did you report on your tax return versus what did they get in terms of those statements? They will send you a letter if there's a discrepancy there. A common mistake is you're forgetting to include a 1099, especially from places like Venmo, PayPal, Stripe, and especially if you also had a side gig, whether you have Etsy income from Uber or different consulting, you want to make sure that even though you did not get a 1099, you're still reporting that income. So make sure you're cross-checking all your income sources before you file your tax return. Red flag number two, earning a high income. Audit rates actually increase significantly once your income surpasses $400,000. Once again, once your income passes $400,000, that's this household income, your audit rates increase significantly. So the IRS has a special division for high earners and pass-through entities. And pass-through entities, once again, are like LLCs, partnerships, S-corporations. So they actually have a special division that's looking into that. And how do you avoid that? You want to, once again, always go back to keeping detailed records so you can really support what you deducted as well as what you're reporting as income on those tax returns. Red flag number three, non-filing, right? So what that basically means is not filing a tax return, right? The IRS tracks individuals who earn over $100,000, but did not file a tax return. Remember, once again, they've already sent out letters based on what I'm looking at here. They've sent out letters to over 125,000 high income earners that did not file a tax return. And they've collected $172 million in back taxes, right? So they are definitely out on the prowl in terms of really looking at who did not file a tax return. So that once again, it goes back to that red flag number one, not reporting all your income. Did the IRS receive a W-2 or 1099? And did that corresponding individual taxpayer file a tax return that matches, right? And once again, if you think about this in general terms, the IRS has limited resources, right? So they can only focus their attention on certain areas. So it makes sense for them to put limitations or narrow their scope to certain income brackets, right? So you definitely want to make sure that if you are above 100,000 or even 400,000 in household income, you want to make sure you're filing every tax return not only timely, but accurately. Red flag number 4 is claiming large deductions or losses. Once again, claiming large deductions or losses. If your deductions or losses are disproportionately high compared to your income, the IRS may investigate. They have these ratios and percentages based on your household income and what you're deducting, whether it's mortgage, interest, whether it's charitable contributions. You want to make sure that if those are disproportionately high compared to your income, that triggers a red flag. Some other common targets are real estate rental losses. One common question that I get from clients is they might have a W-2 job. They're medical professionals. Let's say they work in a hospital or they're doing locums. They have significant income, but they also have a few rental properties. And a lot of them are asking, can I deduct my rental losses to offset my full-time job or my daytime job, right? The answer is typically no, because you need to have active real estate broker status, right? So that basically that is your main job. That should be your main job, is renting it out, maintaining them. You have to cover X number of hours per year, which is a pretty high bar if you already have another job, right? Another W-2. So typically you're going to be categorized as a passive investor and you're capped or you're limited on how much loss you can take. Bad debt write-offs, right? If you have those or investment losses and you're taking significant amounts, that is also a potential red flag. And how to avoid it? Once again, ensure proper documentation. You'll see a reoccurring theme here, right? Ensuring proper documentation for eligible deductions. Red flag number 5 is excessive charitable deductions. This kind of ties into red flag number 4 of claiming large deductions or losses. And once again, the IRS has these tables and ratios knowing the average donation size per income level of the household, right? So if your charitable contributions is so much larger than the income, that's a red flag, right? Specific red flags to really be aware of are donations that far exceed your reported income, as well as if you are making non-cash donations greater than $500, you want to include the Form 8283 to give more details to the IRS of what you contributed, more detailed itemized reports for any non-cash donations over $500. Another thing is if you are donating high value non-cash items, let's say you donate a famous painting or car or a vehicle, an automobile, something like that, you want to keep all the receipts as well as get an appraisal, an official appraisal, right, that you can actually document so you can take that deduction if you're eligible for it. Making sure the documentation is all there really will help and give you a lot less stress when you file and you claim that deduction. Red flag number 6 is running a business as a Schedule C filer. Once again, running a business as a Schedule C filer is a potential red flag that they look at. And Schedule C filers are those that are single member PLLCs or sole proprietors, right? For all you local medical professionals out there, you want to make sure that if you're filing on a Schedule C, that is actually a return or a schedule that the IRS is really scrutinizing. So you want to be careful. And the common issues there are not reporting all business income, excessive deductions for things like meals, travel, and home office expenses, as well as claiming 100% business use of your vehicle as a local professional or a business owner. You want to make sure you have documentation for that. So how to avoid it? Make sure you keep detailed records as well as a mileage log for the usage of your car. And really consider forming an s-corp or a PLLC that elected s-corp status, right, for the tax benefits. And that actually helps lower your audit risk, right? So if you're reporting all your locums activities on the Schedule C, think about forming or electing s-corp status and go back to one of my previous videos, and I'll leave a link up here about is an s-corp right for you? So you want to watch that. Red flag number 7 is writing off hobby losses, right? So what is a hobby versus what is a business? The IRS is very clear. A business is an activity that you pursue with the intent of earning profit, right? But a hobby, most likely you're not really pursuing profit. You're not really doing any kind of marketing or anything like that. And if you're only reporting losses year after year, the IRS may raise their eyebrow and raise a flag and say, hey, is that a hobby or is that really a business? So you really want to make sure that the losses that you're taking are for a business. A business, once again, is an activity that you have clear intent to make a profit. So you show revenue, advertising, business plans, right? So you want to make sure you're really documenting those things. Now let's get right into how to protect yourself from an IRS audit, right? So we just had the last 7 red flags, but now let's go over my 4 tips to protect yourself from IRS audit. So tip number 1, keep impeccable records. Once again, keep impeccable documentation and records. So that's receipts, invoices, bank statements for at least 3 years after you file. People ask me that question all the time. How long should I keep tax records and documents? It's 3 years from the date you file your tax return. Okay, so if you file your 2024 tax return, let's say April 15th, 2025, you want to keep it till April of 2028. Okay, so 3 years after. So make sure not only, and if you don't want to keep paper, scan it and keep a digital record, right? Scan it and keep a digital record, or use bookkeeping software. There's a lot of really good bookkeeping softwares out there, QuickBooks, Xero, Expensify. You want to keep good documentation. Tip number 2 is report all income correctly. And in my previous episode, I was talking about there are people that file too early or too quickly and not receive all the tax documents. So don't be in that boat, right? You want to double check that you received all your W-2s, your 1099s, and your K, and that you're reporting them fully on your income tax returns. Remember also to report side income, even if you didn't receive a Form 1099. Not receiving a Form 1099 does not exempt you from having to report that income. Remember, the IRS rule, and for tax authorities, even if you earn a single dollar, you have to report that. A single dollar, you have to report that. So even if you didn't receive a 1099, it's up to you to self-report that income. Tip number 3 is to file accurately and electronically. E-filing reduces errors as well as speeds up the refunds if you're eligible. Or use tax software or hire a licensed CPA or tax professional. That goes a long way to give you peace of mind. And I know that my clients definitely have peace of mind knowing that Steve is filing their taxes, right? Knowing that Steve has their back. If something were to happen or go wrong, I'm there to take care of them. So you want to make sure you're using software or a licensed tax professional. And tip number 4, avoid too good to be true deductions. Once again, that one motto in life, if it sounds too good to be true, it probably is. So if there's an investment, and one investment program that really comes to mind that's been in the IRS a lot these days is something called conservation easements, where you contribute or you invest X amount and you get a multiplier of 5, 7, 10x of whatever that was as a tax deduction. Be aware of that. The IRS is definitely cracking down and auditing and really questioning that large, too good to be true tax deduction. So you want to be careful of that. So that's why another good reason to have a tax professional on your side to really be a sounding board. Does this make sense? Is this risky? And once again, you don't want to ever exaggerate your deductions, right? Because the IRS has benchmarks for your income, for your household income level, right? Charitable deductions and different types of deductions that you want to make sure you're staying within reason, right? So avoiding an IRS audit isn't about luck. A lot of people say that I haven't been audited, I must be really lucky. That's not necessarily true. You've done all the right things, you're conservatively reporting, and you have supporting documentation. That's the biggest takeaway, is always having good supporting documentation for everything you report on your tax return. Now you can file with confidence, sleep easy at night as a locum professional or business owner, and make sure to always tune in to this channel to hear some great tax saving strategies as well as financial advice. Until next time, I will see you again. Bye.